Start.
Yes,
Good
we are
afternoon, sir.
about to start, sir. Good afternoon, sir. Perfect. I think we are good to start on our session today, and the agenda for the day, I think, is fixed income, and we are moving towards session two of fixed income to that extent. Uh, just quickly set this up for you. Yep.
Sir, your
Uh,
camera is
s-
off.
I have a technical issue with my camera today, so
Yeah.
I would not be able to switch it on. थोड़ा सा लैपटॉप चेंज करे.
Okay.
ठीक है, so I think we can manage it this way, then that helps.
Okay.
Okay, perfect. So last time when we talked about fixed income, we did discuss basic concepts around fixed income in terms of how do you define a bond and what are the key issues or the key terms associated with bonds, such as an issuer, par value, maturity. There is then number of years of the tenor which is left after maturity, coupon rate, and a yield to maturity. So I think we did discuss around how do you basically look at a bond when you're trying to invest in a bond, and this would include doing a lot of due diligence for the bond. Now, the agenda for today obviously is looking at different types of bonds in a bit more detail, which sees corporate issuers, government issuers, and how do the bonds vary between the corporate and the government, along with some very important relationships between the price and the yield. Right. So I think the broader and the larger agenda for today would be the prices and yield. I think because a lot of questions will come from that part of the reading where you have you know relationships between price and yield, and people are going to obviously have a lot of questions around the price and yield mathematics. So I think that is where we'll end our day with. Now, when we say fixed income market for corporate issuers, we are talking about largely companies who will issue bonds, or companies which will typically roll out bonds and raise money. Always remember, when there is a corporate issuer, the issuer is raising money by selling these bonds. Let's get into it then. Now, the first thing when we say why is a company issuing bond and what is the purpose of issuing these bonds, the straight answer is funding, right? And short-term funding alternatives is what the company may be looking at. The purpose to understand how companies and financial institutions meet their short-term funding needs to manage liquidity and control cost and risk in this process. So they need money, right? Important is they need money, but with that money, they will also have to control the cost of that money, right? They don't want to raise money at a very high interest rate. They would want money at a rate which is reasonably low. Now, therefore, we say this refers to financing obtained for less than 1 year. And if you remember, less than 1 year was all what we referred as money market. Last time when we said less than 1 year securities, they called them the money market bonds. Greater than 1 year maturity, and we said greater than 1 year maturity will be all capital market. So this less than 1 year financing need which they will raise is to meet temporary cash flow and working capital needs. Working capital is always required for your short term business, right? If you want to run the business in a short run, you need money for working capital. And then companies can be broken down into two categories, or corporates can be broken down into two broad categories: non financial corporations and financial institutions. Example, manufacturers and retailers in non-financial corporations. So anything like a steel business or a cement company, an automobile company, everything is a non-financial corporation. They borrow mainly to fund operations and current assets, right? Which is working capital, right? If you want to fund your working capital, you need to buy raw material in short term for manufacturing processes. You need to make labor payments in short term. For all those purposes, when the money is borrowed, we call it typically for operation and current asset basis. And then financial institutions borrow to fund loans, trading positions, and customer withdrawals. Now, this is where your banks typically come into picture, or non-banking finance companies, where they need money short term to ensure their asset liability match happens, right? So if there is excessive withdrawal from a bank and the bank needs to obviously make payments towards withdrawal, the bank may borrow in the short run from RBI or from other banks. So each of these will face different regulations, risk, and funding options. The aspect, obviously, when we say cost wise, interest rate is what we are talking about. And we need it lower because it affects profitability. If you have high interest rates instruments, then your profitability will be lower to that extent. So you will need interest rates to be as low as possible when you're raising it. Reliability, when you're looking at short-term funding alternatives, reliability, you should have access to funds. If you need the money today, you should have someone who is reliable and who doesn't deny you that payment, who says, okay, I'm going to give you the money today. It's certain you get access to money. And it determines liquidity planning and risk tolerance. Just think about it. You need money and someone denies it that day, that, okay, no, 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 I can't give you the money this today. That is a fundamental problem. Then you are into a problem because then you don't know where to source your funding from. So reliability is critical. And then there is collateral. Obviously, if you are going to borrow, right, if you're going to raise money, you may have to pay collateral, or you may have to deposit a collateral, give a collateral. Collateral is nothing but security. It's like a asset which you are going to pledge to secure loan. Pledge means you're going to keep it as a collateral, and the more the collateral you can offer, the better the credit rating, the more you have the borrowing capacity, and lesser the interest rates, right? So higher the collateral, lower the interest rates, credit rating obviously is better, and the borrowing capacity is also better. You can borrow more if you have more collateral, right? And collateral will typically be either tangible assets, like, real estate, you could have gold, you could have any tangible asset, or it could also be financial assets like fixed deposits that you can give as collateral. Then there is rollover risk of not being able to renew or replace short-term debt, critical for ongoing liquidity management. The possibility that you borrowed money and the lender wants the money back, right? So you have to give him the money back and you have to replace that loan with another loan, so that at least your working capital keeps going on. But there's always a risk. If you're not able to do that, then that is a risk for the business. So we generally, when we look at short-term funding alternatives, we are trying to look at these aspects before deciding that, okay, do I need to borrow it from a bank? Do I need to borrow it from a non-banking finance company? Do I need to borrow it from someone else? Let us compare the borrowing across these parameters to decide which of them is a better way or better measure for borrowing money. Now, when we look at short-term funding for non-financial corporations, the purpose, as we said, is to meet working capital, right? Automobile companies will need it for their day-to-day business. Main source, they can get external loan from banks via line of credit, and they can also get external security based financing like commercial paper. They can sell their own commercial paper and raise money. If we say external loan financing from bank lines of credit, three types of line of credit: uncommitted, committed, and revolving. In the prior session also, I think we have talked about these three, but we'll put it in a more formal format here. Informal credit, when you say uncommitted line of credit, the word uncommitted means the there is no guarantee you're going to get this money. The lender can deny the payment at certain times. So this is informal credit offer with no guarantee of funding. Floating rate, so there will be a reference rate plus a spread. The rate will keep changing depending on different time frames. Flexible with minimal fees, and maybe unsecured if borrower holds deposits, right? So the risk with uncommitted line of credit rate, biggest risk is this: there is no guarantee that you're going to get this. You have a bank who says, I'm going to give you uncommitted line of credit. The uncommitted word itself explains that if possible, the bank can deny this. And then you may have to look for alternative sources of financing. Then comes committed line of credit. The bank commits to lend for a fixed term. This is more reliable because the bank has committed to give this money to you, and therefore carries a commitment fees of 50 basis point, or let's say 0.5%. This gives you guarantee that you will get the money as and when you need the money. But this is also subject to renewal risk at maturity. At maturity, the bank may not renew it. That is at the discretion of the bank. And then there is a revolving line of credit. long-term renewable source of funding, right? You have a, let's say, a revolving line of credit of 10 lakhs. You borrow three, then you pay back two, then you borrow four again, then you pay back one again, and you keep doing it, right? So you withdraw three, pay back two, withdraw four, pay back one. You can keep borrowing and keep repaying. It's a revolving line. This may also include covenants and fees, and often treated like a medium term facility. Given this is a revolving line of credit, this keeps revolving, and you can just keep withdrawing and keep repaying and keep withdrawing in this facility. The amount is agreed at the inception of the facility. That what is the revolving line of credit we are looking at. Then for non-financial corporation, we have secured loans and factoring. Secured loans are like term loans, right? A lot of banks will give you term loans, and these term loans are typically for growth or for your working capital requirement. This is called as growth capital at times or working capital loans. When we say secured loans and related factoring, firms with weaker credit pledge assets as collateral. I give assets, right? I'll give you a real estate property as an asset. And this is therefore called as sometimes asset backed loans, where they are secured by receivable, inventory, any asset where there is cash parked. So we can get secured loans, and secured loans can also help you bridge the financing. Along with this, there is a concept of raising money by way of factoring. Factoring means, let's say you have an invoice and the invoice is of 100 crores. So a customer is pending to make 100 crore worth of payment. This invoice is obviously payable, sorry, after, let's say, 180 days. But you need the money today. Your customer is going to make the payment after 180 days, and you need the money today. I'm sorry. So what are you going to do? You can take this invoice to a factor. It's called a factor. Like there is a SBI subsidiary called SBI Factors. You can take this money to SBI Factors, and SBI Factors is going to discount this invoice, right? This is called as bill discounting also. Some of you might have read it in the terms of bill discounting. So they will discount your receivable and give you money against this. So for example, SBI Factors will say, okay, I can give you 85 or 90 crores today, take 90 crores, and I will collect the money from the customer after 180 days and make a 10 crore profit, or a 95 crore, I'll make a 5 crore profit. So you can sell your invoices at a discount, and that is called as factoring. Now this discount depends on how much the bank wants in terms of interest and how much effort will it be for the bank to collect this money. So collection cost plus the implied interest. Okay, just bear with me. I have a very bad cough and cold, but that's fine. I think I'll try and stick around. So discount rate is all about whether you will get a 90 or 92 or 95. It all depends how much is the bank's interest that the bank would like to earn, and along with bank interest, the collection cost. What is the cost of collecting this money? So higher the cost, the bank will have a higher discount applicable. Now, along with these sources of financing, there is also a financing option that is available by way of external security based financing, where a company can sell commercial paper, and based on that commercial paper, the company can raise money. When we say commercial paper, we are saying short term unsecured debt, maturity of less than 3 months. You want to sell a very short term unsecured debt. It's unsecured, which means whoever buys the commercial paper has a higher risk. It has low cost versus a bank loan because it's a very short term instrument, 1 month, 2 month, 3 month instruments, and used for working capital or bridge financing, right? So again, this is trying to fulfill your short term working capital requirement. Key thing, there's a rollover risk. You cannot sell new CPs when existing matures, right? So you will have to then find new investors again. Your old investor, you cannot sell him the same security. Once this matures, you will have to obviously make the payment back, and then you will have to raise additional money. Second, mitigated by backup lines of credit, right? So you have a backup line which can help you reduce this risk, that when someone says, okay, commercial paper is set to be mature, you can repay that uh, later with a backup line of credit. Then comes for financial institutions. And now comes, I think, a lot of the things like repo, repurchase options, commercial certificate of deposits, etc. So when we say short-term funding for financial institutions, banks, right, and they would generally need short-term financing because they might have an asset liability mismatch otherwise, right? So when we are saying a short-term financing is required, in that category, they can have a short-term funding need, and one of the easiest way to get short-term funding is demand deposits, right? Bank use deposits as key short-term funding, right? You don't pay them the interest, but this is one of your basic short-term requirements. Savings deposits, all the money that we put in terms of fixed deposits or recurring deposits, all of them is their short-term funding. We provide them funding, and they use this funding largely from our perspective. Then comes certificate of deposit, CDs, right? So like corporates have commercial paper, we have CDs here. Now, certificate of deposits are also of multiple types. Certificate of deposit is negotiable CDs. When we say negotiable CDs, can be traded in open market. Non-negotiable CDs, early withdrawal will lead to penalties. And again, it's up to the financial institution to decide what type of commercial deposit would they like to sell in this market. Is it a negotiable CD or is it a non-negotiable CD? In case of a non-negotiable CD, the deposit plus interest are paid at maturity, and if the depositor withdraws funds prior to maturity date, a penalty is imposed. Okay. While on the contrary, a negotiable CD can be sold to another investor prior to maturity date, and most of the CDs are short term. Remember that only difference between CDs and CPs. CPs are more or less commercial papers by corporates, while CDs are more of an instrument which is sold by the financial institutions. So I think that is key thing. The purpose of both of them is to raise money for short-term liquidity positions. Financial institutions can also raise money via several other fundings like interbank and repo funding. Interbank funds, once again, short-term loans between banks itself, which can range from 1 day to an year. Then comes your repos, and repo itself has two parts, REPO, which means repurchase options. These are repurchase agreements, and we will shortly cover about this, but once again, these are secured borrowing using securities as collateral. You're once again using securities as collateral uh, to raise money. Interbank rate, as we talked about last time, and if you remember, there we said earlier there was a rate called LIBOR, but now LIBOR is no more available in the market. It is retired as a concept, and now everyone borrows at SOFR, secured overnight financing rate. So SOFR is nowadays used for interbank funding in the international markets. Then, if interbank and repo funding is an option available, the second option available is central bank and discount window, which is where you can straight away borrow money from the central bank of the specific country, like RBI. Central bank fund market, banks lend excess reserves to other. Rate is central bank fund rate, right? So repo and reverse repo rates, like we have in India, we call them a repo and a reverse repo, at which you can borrow from RBI and you can lend to RBI as rates. These are largely influenced by monetary policy. RBI policy decides what will be these rates whether that's a repo rate or whether that is a reverse repo rate. Along with this, there is a discount window lending, which is your lender of last resort, and you will have typically a higher interest rates in that category. Commercial, yeah, the corporations always need money on the short term basis, but for corporations, they can still manage and wait for a day or two if it is not available. But for banks, it is utmost important to have short term liquidity, because if there is a withdrawal which a bank has to offer, right? If a customer withdraws his money, the bank has to obviously make that payment upfront, right? The bank cannot do it. The bank cannot deny that payment. Okay. So for banks, it is more critical to have short-term source of financing in place. Next comes commercial papers, right? And when we say commercial papers, bank issues more CPs than corporate. Obviously, as I said, banks will need more money than anyone else, right? Banks will obviously need more money because they cannot deny short-term commitments. They have to still fulfill short-term obligations. Whether I break my fixed deposit and ask for money, whether I withdraw my money from a bank ATM, everyone that money has to be provided to a large extent, and no one can deny that arrangement. So bank transfers short-term loans to SPE, which is a special purpose entity, right? So the idea is often you will sell asset-backed commercial paper, and asset-backed commercial papers will be, uh, let me just see if I have a diagram somewhere here. Let's paste to make that diagram. Yes. So let's say I'll just make it here for you. This is a special purpose entity, and this is a bank which has given some loans, right? So when I say asset-backed commercial paper, bank transfers short-term loans to SPE. Okay, so banks will give loans here, transfer the loans, which they've already given to several individuals, right? Bank has given a lot of loans to this side. Banks transfer the loans, SP sells these loans forward, right? And once the loans are sold, SP gets it from investors, right? Several other investors will buy these loans. These investors may include investment banks, pension funds, you can have sovereign funds, you could have insurance companies. There are a lot of institutional large investors who would like to buy these securities which the SPE is selling. So when the SPE sells these securities to these investors, the investors make them a payment, and that payment is then given to the bank to provide liquidity. So in all of these cases where we say that the banks will transfer short-term loans to SPE, SPV will issue ABCP to investors, which is asset-backed commercial papers to the investors, and provide liquidity to the bank uh, over a period of time. So this can also be seen as a practice. Now, the idea is non-financial corporations and financial institutions, as we said, the difference is largely in the type of facilities. Like these guys will have lines of credit and CPs. These guys will have commercial deposits or normal time deposits, right? You could have CASA, current account, saving account money that the banks get. Again, interbank funding is available, and commercial papers can be sold via the asset-backed route. Collateral required for weak credit, typically secured. Bank will typically have secured fundraise. And again, interest rates, risk, and backup funding is available to most of them. Like for them, I think the central bank or RBI is the lender of last resort. If a bank does not get funding from anywhere, RBI is I think the one entity which is going to obviously give that loan to you. Okay. Now let's understand these repo agreements as we talked about, what are these repurchase agreements? Uh, as we said, repurchase agreements are nothing but short-term borrowing arrangements where one party sells a security and agrees to repurchase it later, right? Which is why it is called as repurchase agreement. I'm going to sell you something, and I'm also going to agree to repurchase it later at a different price. And that price will typically be higher. That is the only reason why you will be profitable. I will sell it to you at 98 rupees. So you give me 98, and then I'm going to repurchase it back at 100 rupees. So I'll give you 100 back. So which is why we say, okay, this will be a benefit for you. You will make 2 rupees in this short-term arrangement. Essentially, this is nothing but a collateralized loan using securities, usually government bonds, right? So it's a type of loan which we raise, and this is done by ensuring there will be a repurchase option available. The difference in the prices, this 2 rupee difference that I'm talking about, is equal to the interest earned by the lender. The seller sells a bond, buyer pays the cash, and then later the seller repurchases the bond. And the 2 rupee that the buyer makes is his profit here. Let's say how the repos work and what are the key variables in it. First, there is a borrower who is the seller. He sells securities for cash and agrees to buy back them later. Same process, sell security. Lender is the buyer, provides cash and holds securities as collateral. Then repo rate, the interest rate implied by the price difference. The 2 rupee is the profit, and that determines the interest that you're going to get. So you are investing obviously 98 rupees. This is your implied interest, 2 upon 98. Initial margin, extra collateral pledged to protect lender, right? You will typically provide more than 100% of collateral. So I'm going to give you, let's say, 110 rupees of government bond. I will borrow 98 rupees against this. You have 12 rupees of extra collateral which I've given to you, so that just in case the value of the bond falls, you still have some risk or some safe option available. Discount on the collateral value when calculating the loan amount, right? So the discount is 12 rupees. That is the haircut I'm giving you. And variation margin, additional collateral required if the market value of the collateral falls. If this 110 goes to, let's say, 102, I may ask you to give me more collateral because I am not going to take the risk of losing my money as a lender, right? So these are all lender related aspect. Haircut is provided by the lender, and this is what the lender will ask, and this is what you give to the lender as initial margin. Now, how does this facility work? This repurchase option arrangement can span from overnight, which means one day, where you borrow just for one day, to extended periods, which are called as term repos. So there are overnight repos and there are term repos. It is commonly used by financial institutions either as the seller or borrower to secure funding for securities involved in their trading operations, or to generate a repo rate on short-term funds. Just a minute. Now, when we are saying these repurchase options are available, this, as I said, these are typically commonly used by financial institutions, either as the seller or the borrower to secure funding for securities involved in their trading operations, or to generate a repo rate on surplus short-term funds. Sorry. Oops, just a minute. I think this. Where is. Just a minute. I think there is a problem with this sharing screen. Once again. Yep. I think I'll have to roll it again for you. Yep. Okay, so let's look at some examples in terms of how the mathematical construct of these repo agreements would work. Now, 100 million 5-year US Treasury note sold under a repo for repurchase in 30 days at a repo rate of 0.25%. Borrower sells the note today, receiving a loan of 100 million, right? So this says this is a 100 million US 5-year Treasury note sold under a repo for repurchase in 30 days. The option to repurchase is in 30 days at a repo rate of 0.25%. So simple, the borrower will sell this note today and receive a loan of 100 million. In 30 days, the borrower will repurchase the note and pay lender an interest of how much? So the simple math would be $100 million of principal into 1 plus 0.25%, which is the repo rate, by 12, because it's a monthly arrangement. We are doing it only for 30 days. So we are doing a monthly arrangement. So the amount that would be paid back is 100 million plus $20,833 paid to the borrower here, or to the lender here largely. So that's a repurchase agreement. It's as good as a loan. I think the only difference between this and any other loan is there is a repurchase option available, and that repurchase option makes it important to that extent that okay, there is almost a guarantee that okay, this money would be paid back at a fixed rate. Now, apart from this, what else can we look at when we are doing repurchase agreements? So when we are doing repurchase agreement, apart from what we have just seen, there is also initial margin available, right? And that initial margin is the security price upon the purchase price. Repo haircut, security price minus the purchase price divided by the security price. So 98 and 100 example, if you see, the initial margin is 98 is the security price, the purchase price is 100. So the initial margin is around 98%. The haircut is obviously what you are getting as a 2 rupee discount or lesser amount on your security, and that is your haircut. So 98 is the security price, 100 is your purchase price, 98% margin, and the haircut that I'm going to give you on your security is this 98 minus 100 upon 98, which means you are getting a 2 rupee haircut on a 98 rupee security. So in percentage terms, that becomes your repo haircut. And then there is variation margin. Initial margin percentage 98% multiplied by the purchase price at time equal to T, which is let's say 30 days, right? Which you are going to purchase it at 100 minus the security price at time equal to T. The security price at time equal to T could be anything, right? So whatever is the difference is a variation margin, where purchase price at time equal to T is original purchase price into the implied interest, like we just did. We did a 1 plus 0.25% interest divided by 12, right? So this is something we did. We considered 30 upon 360, right? Which is nothing but 1 upon uh, 12 to that extent. So this will help us estimate the return that is available to the lender. Like in this case, we said $20,000 is available to the lender, and that is 30 upon 360 days, or 1 upon 12 is the number that we divided our interest rates by. Let's look at one more example then. Now use the same example as before, but with an initial margin requirement of 102%. Find purchase price, repo haircut percentage, and repurchase price. Okay. So look, now the borrower sells the note today, receiving a loan of, the margin is 102%. Your security price is $100 million. So the purchase price will be $98 million. You will simply divide 100 by 102%, and you will get your purchase price of $98 million. The haircut, therefore, will be security price 100 minus purchase price 98 divided by 100 of 1.96%. And the repurchase price is your purchase price into 1 plus 0.25% 12, this. So the loan of 98,039,216 had an interest cost of 2425 because you have to pay 2425 additional. You borrowed 98,039,216 and you have to pay back 98,059,641. So the difference between the two is your $20,425, which is your interest cost. So the fundamental arrangement of lending or the discussions still remain the same. The discussions are still the same. We are still borrowing. We are still lending. The only thing is this is very, very short-term lending. Questions? Anything on this? Okay. Let's give it a try. One more example. Now, same example as above, but after the first 5 days, the price of the security fell to $99 million. Now, this is where we are saying that this $99 million, the original purchase price is 98. But now variation margin comes into picture because if your prices have fallen down, you will have to apply the concept of variation margin. I'll take you back to variation margin. Variation margin means additional collateral required if the market value falls. If the market value of your security falls, then you will have to give more collateral, because if you don't give me more collateral, then I am at a risk as a lender, right? So purchase price at day 5, there is a new value of the original value of the security into this 5 days later. The value is 98,042 with 102% of initial margin requirement. My variation margin is $1 million, which means you will have to deposit an additional $1 million to ensure that my risk is still managed properly. Right. So when we say variation margin, one thing was additional collateral. Second, when is it needed? When market value falls. Third, how do you calculate a variation margin? Initial margin percentage, 102% multiplied by purchase price at time equal to T, which means at time equal to 5 days for us, minus security price at time equal to T. And that is what we are doing here. We are calculating price at day 5. And we are using that at day 5 with our price, which was our initial market price, the current market price, what it is fallen to. This gives you your variation margin, which you will have to deposit additional. And this additional margin will provide a comfort or safety to the lender. Now, types of repos: overnight repo, which is 1 day borrowing renewed daily; term repo, the maturity is longer than 1 day; general collateral repo, any security meeting agreed quality standards; special repo, special security in demand, often lower or even negative rates; and reverse repo, where investors lend cash and receive security as collateral. So again, within repo also, repos will vary based on two parameters. One, they will vary based on the time. Second, they are going to vary based on the collateral, or I think let's better call it based on the security that is offered as a collateral. Based on these two parameters, you will have different types of repo. Within repo, you will also have bilateral or tri-party repo, right? When we say bilateral, between two parties. Tri-party itself, the word says third party custodian manages collateral. which means there will be a third party custodian like an escrow, right? And that will help us reduce risk or eliminate default risk, credit risk, right? So the third party helps us eliminate credit risk for a small fee. And in this category, remember, I think one slide back forward we have when will be your repo rate higher, right? Repo rate will be higher if there is risk of quality credit default, right? For example, why do you need a tri-party collateral or tri-party repo, as I said? If I have a tri-party repo or a bilateral repo or any other repo, look at the factors. If you have high market interest rates, your repo rate typically increases. This happens if RBI increases rates, repo rate will also be increasing if market interest rates increase in general. High collateral quality, repo rate decreases. If you offer me very good collateral like government bonds, the repo rate decreases. Longer maturity, the longer the borrowing, repo rate increases because long maturity means higher risk. Your repo rate will increase. And high demand for collateral. If the demand for the collateral offered is very high, the repo rate will decrease because then the collateral is desirable. This is a collateral which is desirable. This is a very good collateral that you are providing. Under collateralization or delivery issue, if you have not provided sufficient collateral, which means insufficient collateral, if insufficient collateral is provided, repo rate will increase because the risk increases, right? And because the risk increases, the collateral or repo rate will also increase. So from an exam perspective, several times you will be asked this question that, okay, what happens to repo rate based on these parameters? And at times, some of these answers are also common sense, right? They are generally something that you think about it and you will understand. Just think about, for example, long maturity. Think about it. I borrow money from you for 1 month versus I'm borrowing money from you for 10 years. Where is your risk more? Because if I'm going to borrow it for 1 year, you or 1 month, for example, okay, in 1 month, Tarun will eventually give the money back. It's not too long a time. You can predict 1 month easily, or let's say relatively easily. But 10 years is a big time, and you are not sure what happens after 10 years, right? So the predictability itself is a bit questionable and challenging. Along with this, obviously look at several other parameters as listed on the left hand side of the screen. Short-term funds cost more. Others, if you're not using repo, other funds will cost you more. Maturity is longer. Collateral is specified but not actually delivered. Lower credit quality of security. Again, for all of these things, you will have higher repo rates. Collateral security has low demand. As we said, low demand means higher rates because if it's high demand, it's lower rate. So if default risk, collateral risk, margin risk, or legal risk, if anything is higher, if we think the risk is higher, obviously if the risk is higher, your rate will also be higher. The return that the counterparty would want is also higher. Couple of quick questions then. Which of the following statements about repos is correct? Financial market participants use the repo market to earn short-term income by lending funds on a secured basis. We just talked about it. Yes, investors can generate higher returns for shorter repo terms. So the returns are, again, when we are saying higher returns, you will have higher returns for longer tenures because the risk is higher in long tenure. So if the risk is higher, the returns will also be higher in long tenures, not in short tenures. From a security buyer perspective, a repo offers a short-term cash. From a security buyer perspective, a repo offers a short-term cash investment on a collateralized basis with significant liquidity or default risk. Okay, so there is no significant liquidity here, right? There is minimal liquidity. It's not as if these instruments are trading frequently on the market, right? Unless and until they don't trade frequently on the market, it is very difficult to say that there is, there is substantial liquidity around, right? So the correct option from our perspective is option A, where a financial market participant will use the repo market to earn short-term income, and this short-term income by lending funds on a secured basis. Clear? Questions? Okay. Now, long-term funding in the same context up till now, I think whatever we have talked about is all about short-term funding requirements, right? When a company has a short-term funding requirement, they will typically look at commercial paper, corporate certificate of deposits, repos, interbank lending arrangements, etc. But if you're looking at long-term funding, there are two categories to talk about: investment grade versus high yield. You remember last time when we discussed, we said there is a rating scale, right? And because there is a rating scale, like a triple A, double A, and the triple B, double B, B, and then there's a triple C, double C, and a C. After a specific line, these are all investment grade, which means these are all good ratings, investment grade ratings. And these are all high yield, non-investment grade ratings, which means high yield are high risk or non-investment grade ratings. So when we are looking at long-term funding, bond yields tend to be higher for maturities with long time frame. The reason we just talked about previously in the question, longer the time frame, more is the risk, and higher the risk, higher is the yield or interest rate on the bond. So when comparing high yield bonds to investment grade bonds, several distinctions emerge. When you're comparing these high yield to investment grade, non-investment grade to investment grade, what are the differences between this and this? Difference in yield across maturities will be greater. Yes, if you're going to go from 1 year maturity to 10-year maturity for triple A, the yield will increase. And if you go from triple A to triple C, the yields also increase because the risk is increasing. There is elevated level of apprehension regarding the default risk. The default risk is higher in these ratings, which is why these are called as high yield. We believe the risk of default is higher. Credit spreads account for a large portion of the yield. When we say credit spread, yield is a function of the reference rate plus spread. So this spread keeps increasing if the risk keeps increasing from triple A to triple C. The reference rate may remain same largely for all of us, but the spread will keep increasing. More restrictive covenants and the need for collateral. Because these are high risk, these are high yield securities, we ask for higher covenants, right? More restrictive covenants, right? So when we say restrictive covenants, we are saying, okay, the risk is too much for high yield. And because the risk is too much, I want more restrictions, put more restrictions on the borrower, and also provide more collateral because I'm buying a bond which is a high yield bond. Bond issues are less uniform and more tailored to specific circumstances. All issues, therefore, do not have the same template, right? Every issue will be different because in every issue you will have different issuer, different rating, different tenure, different type of collateral. So none of them are one fit all solution. Everyone will have a different funding or type of solution offered to the investor. So in long term, it's always a decision between investment grade versus high yield security. What security are you trying to invest into? Clear? Concerns? Anything that you missed out you want me to repeat? All good? Okay, perfect. Yep. If you don't have any questions, that's fine. Really good. Then let's move to the next slide. Now, this is all about corporate issuers, right? When we are saying this is all about corporate issuers, and now we also need to look at how do the government work in this market? What are the government issuers trying to work in this market with? How does the government bond market or the government securities function here? So now from a government security perspective, if you're talking about from a government market perspective, because bonds are generally very heavy on government markets, there's a sovereign debt. And I think you might have heard a lot around debt positions for other countries like US, a very large debt market position, right? So sovereign debt is all about the national government issuing bonds to finance public goods, services, and infrastructure, right? The government borrowing basically. And I think I had some numbers for you right before I think we started the class. I was just trying to collect some numbers for you. Let me just quickly showcase that number. Where is that infographic I was able to collect? I'll just put that graphic for you. Just a minute. Where is that graphic saved? Let me just find it again for you. Yes, I think this is what we were looking at. And let me just put this on your screens. Visualizing government debt numbers. And confirm me once you are able to see this graphic. Okay, and this is what we are talking about, right? When we say government debt, and you need to look at the amount of debt some of these countries carry, and this is still older data. This is, I think, data which is April 2025, taken from IMF World Bank Economic Outlook. But I think this is what we are talking. US has 123% debt as compared to their GDP, right? These are all ratios with the highest debt to GDP ratio, right? So if US GDP is, let's say, $100 trillion, they are looking at $123 trillion of debt. And these are countries which have a lot of debt as compared to their GDP ratios, versus other countries like, all the countries are here, and India would be somewhere around 80-90%. Here is India, right? And again, these numbers are a bit old, but I think this explains you how much debt all of these countries have. General government gross debt is the sum of financial liabilities at all level, central, state, and local, right? And the risk is when you are having more than 250%, more than 200% of debt on your balance sheet as compared to your GDP. This is as good as saying that you are earning 100 rupees, but your debt is 120 rupees or 200 rupees, which I'm sure you understand is very high risk. So national government issues bonds to finance public goods, services, and infrastructure, right? Their job is to have these things ready for the public, for which they need money. And if they need money, they will issue bonds to finance these. They typically hold the highest credit rating and is one of the largest debt issuers. Government bonds are highest credit rating instruments because, as we said previously also in some of our discussions, government is considered risk free, right? Government is one who's considered risk free. Analysts must assess the economic balance sheet, which encompasses implied assets and liabilities in addition to financial ones in public account. Often offers various maturities to balance long-term and short-term needs. Now, when we say sovereign debt, the sovereign debt is also in different market, developed and emerging markets. Now, what do we mean by developed and emerging markets? Developed markets are typically markets such as US and Europe. Those are two developed markets we are talking about. And when we say developed markets, these are stable, diversified economies with consistent and transparent fiscal policy. Obviously, when you're looking at large economies like US and Europe, we generally believe these are stable economies. These are well diversified economies versus, and again, debt is denominated in their in a reserve currency, like generally acceptable currencies in US dollar or euro. But then there are emerging markets like our market, like our country, where fast growing countries, less stable economies, and less stable tax revenues can be domestic debt, might not be freely convertible to other currencies, or external debt owed to foreign creditors. Like we can owe money to IMF or World Bank, right? And this will be typically either in home currency or in foreign currency reserves. We may have to pay them in INR or we may have to pay them in US dollar terms. Besides emerging markets, then you can also look at debt, but again, very rare, is from frontier markets. What are frontier markets? Frontier markets are markets which are typically African geographies, right? And African geography is known as frontier market. Fairly okay, comfortable. Okay. How does the government manage this then? Government debt management and fiscal policy. So when we read economics, and I think when you will have your economics readings, you'll read about fiscal policy. Fiscal policy affects the borrowing needs. What is a fiscal policy and what are the ways it can work? Two types of fiscal policy, expansionary and contractionary. Expansionary means tax cuts and higher spending, right? So the government is going to give tax cuts. As soon as the government cuts the tax, government gives you more money in your hand. Like the government recently did a GST cut or the GST reduction. So if GST is lowered, there is more money left in an individual's hand. And the individual then therefore can do more spending. And if there is more spending, the government will obviously need money to do it, right? Because tax cuts for the government is lesser revenue. Always remember, tax cuts for you and for me is more in pocket, but tax cuts for the government is lesser revenue. And if they have less revenue, but they have to do more spending, then they need new money. They will have to borrow. So whenever the government says, okay, we have a fiscal policy and it's an expansionary fiscal policy where we are going to spend a lot of money in creating bridges and roads and highways and all of those things, but the government is not having the money, the option is they are going to raise money by selling debt. Then there is contractionary fiscal policy, which means the tax rates will be increased. And if tax rates are going to increase, obviously government revenue is going to increase. And if government revenue is going to increase, they will not have to borrow money from the market. So whenever there is a budget, right, like for us, I think the budget will be rolled out on February 1, generally February 1, but this time around it's I think a Sunday. But let's see, if there's a budget, everyone listens and focuses on government's borrowing number. How much is the government going to borrow? Right. So this number is very important because the more the government borrows, the lesser money will be available for the private sector. Then the private sector obviously has a bit of issue because then lesser money is available, and if money is less, the cost of that money will be higher. So analysts need to assess policy stance. When we say policy stance, is the government going with an expansionary or contractionary policy? Generally, government will spend more when they have to increase the GDP or they have to revive the GDP growth. And revenue sensitivity to growth and inflation, right? How much is the government's revenue sensitive to these numbers. And then the debt features. Are we going to issue a floating rate, guaranteed, index? Which type of debt will we be able to sell in the market? Clear? Quick question. Sovereign debt. US based investors of US dollar denominated external sovereign debt can still face exposure to currency risk because sovereign fixed income securities are denominated in freely floating domestic currencies. The issuer's credit rating may be downgraded. The issuer must be able to generate foreign currency revenues. Okay, so I think the reason is, and I think why we are talking about this, at times, if you don't have foreign currency reserves, how do you make that payment? Okay, so simple example, US based investor, and this guy invests into Indian government bond, and Indian government has issued this bond in US dollar, which means the government will make the payments in USD, US dollar terms. Now, if the Indian government is going to make the payment in US dollar, the problem is, will the government be able to generate foreign currency revenue? What if our US dollar reserves go to zero, right? We don't have any forex reserves. And if we don't have any foreign exchange reserves, the problem is there may not be money to pay back these bonds. So even a US based investor who is a US dollar denominated security can face that risk that there is a possibility of a default in this category. So this is a genuine problem from an investor perspective, that you could have a US dollar denominated external sovereign debt which can also see a default. Then a sovereign government faced with growing deficits, which means fiscal deficit, and concerns about rollover risk, would most likely lower tax rates. Look, you're already running a deficit, you're already a fiscal deficit. Okay, and if you're already a fiscal deficit, which means your taxes are less, you're not going to reduce tax rates more, right? So this option cannot be the case. Stop servicing the debt. You cannot, right? If stop servicing the debt means you're defaulting. So if they are face concerns about rollover risk, they would typically issue medium to long term securities so that the risk is relatively lower. Medium term securities or long term securities will come for maturities later. If there are short term securities, they will mature earlier and they will have more rollover risk. So a government which believes this is the problem can resolve the problem by ensuring that, okay, a part of the debt should be medium to short term, or medium to long term rather. Now, this is your most recent problem, Sri Lanka. A lot of you would have read across what happened on Sri Lanka and the type of unrest we saw in Sri Lanka. Reason, Sri Lanka's external debt in 2021 from different entities, right? They borrowed market debt, China, Japan, and I think everywhere where they have looked at Asian Development Bank. Market debt is primarily international sovereign bonds denominated in US dollars and owned by foreign private investors, including mutual funds. The Sri Lankan government defaulted on some of their positions, and that is always a risk, right? Whenever we read actually these things, and let me go back to that slide. Whenever we read any government sovereign borrowing, we call sovereign as risk free. We generally say sovereign is risk free, right? But remember, even sovereign or even larger countries or countries can default. It's not necessary that they are always risk free. And now, along with this, there are also non-sovereign bonds, which are bonds issued by provinces, regions, states, cities. Now, the classical example is the state of California, right? In US, if California needs some money, it's not necessary that they always go to the Federal Reserve or the government and borrow. The state of California can issue their own bonds. But then state of California is not backed by the sovereign rating. Sovereign is always federal, right? They are this is a city, this is a state, and the state of California not necessarily will be a sovereign. These are non-sovereign government bonds or non-sovereign bonds, simple. Quasi. Quasi government bond means bonds issued by organizations established by national government, right? Like in our case, in our country, if we say you can have NHAI, National Highway Authority of India, right? This is a quasi government. It is established by the national government and therefore called as a quasi government bond or an agency bond. In US, I think the three most famous are Fannie Mae, Freddie Mac, and Ginnie Mae. There is another one which is called as Ginnie Mae, the General National Mortgage Association. So they have a Federal National Mortgage Association, Federal Home Loan Mortgage Corporation, in short, Fannie Mae, Freddie Mac, and your Ginnie Mae again. Then there are supranational bonds. As we have discussed, and this was, I think, also discussed in our prior class. Such bonds are issued by multilateral agencies such as International Bank for Reconstruction and Development, World Bank, or IMF, or ADB like an Asian Development Bank, or an IFC like an International Financial Corporation. So again, in the bond category, you could see bonds issued by some of these entities also. It's not necessary that all the bonds will be issued typically by the government only or the sovereign category only. But obviously, sovereign is the biggest category. Let's put it this way. Now, when we say issuance and trading of government debt, we'll focus a bit here. Generally, government bonds or securities, public auction is used, which means the government auctions the security and sells the security via a route of public auction. Two bid types: competitive bidding and non-competitive bidding. Competitive bidding means it is used to set the price of the issue. Competitive bids are used to set the price of the issue, while non-competitive bids are guaranteed allocation at the auction's final price. So competitive bid, you also bid, I will also bid, and a lot of people who want to buy the bonds will bid. For example, you say I'm going to buy it at 100, I say 101, someone else say 102, someone else say 103. So there will be bidding, and the government will see wherever there is maximum demand, the government will start selling it from that side. So for example, there is a $10 million demand at 103. There is a $3 million demand at 102. There is a $5 million demand at 101. And let's say there is a $1 million demand at 100. So the government, if it has to raise, let's say, 14 million. So government will sell this 10 million at the highest price. Then the government will take this 3 million more, and 1 million bonds will be sold at 101. Right. That way, the government will be able to raise 14 million via way of competitive bidding. Everyone is setting the price, and the government decides, okay, maximum demand is at 103. So let's sell everything at 103, and that is the price of the bond. On the other hand, non-competitive bid, there is already a guaranteed allocation, which is the auction's final price. There's no competition. The government decides the price and says this is the price. Allocation order, first to non-competitive. So first government decided price, and then to competitive bids starting from the highest price. As I said, they start from the highest price, 103, and then go towards the lower price. Cutoff yield, the yield corresponding to the lowest price, or which is the highest yield, successful competitive bid. So there is always a cutoff price, like in IPOs, right? When you apply in an initial public offer, it's like an IPO. The yield corresponding to the lowest price or the highest yield, successful competitive bid. Who participates in this? And I think the word is not visible here. Let me just quickly ensure that you can see that word. PDs. This is an important word from an exam perspective. Primary dealers who participates in issuance and trading of these government bonds. So sovereign issuers designate primary dealers who must submit competitive bid and support auctions. So PDs are generally who are going to be dealing in these bonds most of the times. After issuance, the government bonds trade OTC, which is over the counter, in dealer markets similar to corporate bonds. And last time we discussed on the run, typically most liquid and used as benchmark yield. On the runs mean the most recent bonds, right? These are recent issuances, the ones which have been just issued. So recent issuances are your on the run securities. And those who are, old securities are typically known as your off the run security. So Indian government 2035 bond, which is going to mature in 2035, 10 years from now, is on the run. But the bond which is going to mature in 2034 is off the run. This was issued last year. Now it is only 9-year old, or 9-year left. So this is off the run security. The auction format, single price auction, all successful bidders pay the cutoff price, or multiple price auction, each bidder pays their own bid price. Like in my example, everyone pays their own bid price. Someone pays 103, someone pays 102, or single price where the government decides one price and everyone pays at the same price. So this is what I think you typically see in IPO markets. When there's a book building happens, you and I can provide a bid at a different price. So let's say if the IPO is open and the price of the IPO is 100 to 105, right? So I'm going to bid it at 100, 101 rupee. You bid 102, someone else does 103. But if it is a single price auction, then if the company says I'm going to sell it at 105, then all of us have to buy at 105. If it's multiple price, we buy at different prices. Supranational bond example, member states of a supranational organizational typically share decision making authority and provide implicit and explicit financial support to the organization, resulting in which of the following levels of credit quality amongst these issuers? Highest, right? These are typically highest credit quality instruments because these are supranational organizations and they can raise money from capital markets across maturities. They are able to raise money, right? No one stops IMF from raising money, and IMF as an entity can raise money at its will. Whenever they need money, I think they can raise money very, very easily. Okay, perfect. I think we've talked about a lot of theory, but before we take a break and go to some mathematical exercises, anything that you want me to repeat in terms of what we have talked about? Short-term funding, long-term funding, sovereign debt, non-sovereign debt. Any questions?
Good, sir.
All good? Okay, perfect. So take a break then. I think we are heading into a section which is pretty interesting and pretty important also because a lot of questions are going to come from this specific reading that we are going to now look into, which is price and yields. For example, there is how do you calculate the bond price? What is the discount rate? What is yield to maturity? Relationships between bond prices. So this is where you will have a lot of mathematical numerical examples, some relationships as we have marked. This is important, right? So we are going to obviously work into this. So right after our break, I think we'll pick up this reading and then we'll take it towards the end of our session today. So as usual, let's keep the break now, mid of the session, and 5:28 my clock. So yep, sorry, 15 minutes. Okay, perfect. Welcome back. We're good to start. reading on prices and yields, right? Perfect. So let us just clear this out. Yep. Actually, good. So the agenda for us is now understanding bond prices and the way the mathematical construct works for the bond market. Now, the price of the bond is equal to the present value of all the future cash flows associated with the bond. Simple example, if I say there is a bond and yep, we have an example here. So let me just read this and then we'll go back. But this is for YTM. Okay, let's just design it here. So let's say there is a bond which has a 3-year maturity. Okay, N is equal to 3 year. Coupon rate of the bond, let's say, is 5% per annum. Okay, and this is an annual coupon payment bond. Okay, which means annual payments will be made to you. Par value or face value of the bond is $100. And let's say the YTM of the bond is 6% per annum. These are the four things I've given you. And I'm asking you to calculate what is the price of the bond today, present value of the bond. So when we say bond is equal to the price of the bond is equal to present value of future cash flows, we will have to write the cash flows. So we will say year 1, year 2, year 3. I will have cash flows. Now what are my cash? I'm going to get coupon payments, which means I'm going to get interest payments. My first interest payment will be this multiplied by this, which means I will get $5. Second interest payment again $5 and third interest payment again $5. Plus I will get principal payments. Principal payment at maturity. So at maturity I'm going to get my $100 back, which is the face value. So my total cash flows will be $5, $5, $105. And now we need to do a present value of these cash flows. So we are going to divide these numbers 1 plus 6% raised to the power 2 and 1 plus 6% raised to the power 3 and add them. What you get is the price of the bond. So a price of the bond is equal to the present value of future cash flows. This is my future cash flow. This is my present value of those future cash flows. And if I add them, I will get the price of the bond today, P0. So whenever you have to do a bond price calculation, you will have to estimate coupons. You will have to also add what you're going to get in maturity and discount them using YTM. The YTM is your discount rate. So we're going to discount them using YTM for year 1, year 2, and year 3.
So the answer is 97.33.
Yes, I think whatever the number comes out here, I've not solved this, but yeah, if you are going to solve this using a calculator, okay, you don't have to obviously do this mathematically. This is just to explain you. If you run it through a calculator, your calculator is capable enough to solve this. We have
Yeah,
already done 4 cases.
we
Yeah,
did it
perfect.
in last class, so we did it that way.
Perfect. So if you are going to use it on calculator, this is how the math works out. Okay. So now the market discount rate is used in calculation to obtain the present value, and it is called as the required yield or the required rate of return, or more commonly known as YTM, right? So always remember that YTM is the required rate of return or the yield. Now in bond market, there is one simple thing for us to understand. What is the difference between YTM and coupon rate? Because both of them are in percentage. The easiest way I remember this, and this helps me always, coupon rate is what the company is offering you, right? So my company is telling you that I'm going to give you 5% coupon, which means I'm going to give you 5% interest rates. Yield to maturity is your required return. This is what you need. So between what I offer you and what you need, there could be a difference. I am offering you 5%, you want 6%. There's a possibility. Or you want 5%, I am offering as a company 6%. That's also a possibility. or equal. You need 5%, and I am also offering 5%. So there are all three scenarios possible. So yield to maturity is the internal rate of return on a future cash flow, always in the denominator if you see here, R. It is the discount rate at which the present value of all future cash flows equal to the price of the bond. So if this is the price of the bond, right? Suppose a 4-year 5% coupon payment bond is selling at 105 premium, right? When we say premium, because it is selling above the face value. If it is selling below the face value, that is discount. So if trading above face value, it's a premium bond. So the price is 5105, 5% annual coupon, which means $5, $5, $5, $5, 4 coupons. Plus, in the end, you will also get your principal payment of $100 discounted at a rate R. And we have to solve for this R. We have to find what is this R, which is my yield to maturity. So your calculator should give you a number which says 3.6% if you use here. The left hand side and the right hand side of the equation will be the same. It represents bonds implied market required return, the return that you want. So rate of return on the bond will equal YTM if these conditions are fulfilled. The bond is held until maturity, right? You will get this return of 3.6% if you hold the bond till maturity. You buy the bond today, hold it for 4 years, and after 4 years, what you will get it as 3.6% return. The second thing, the issuer does not default, and all the payments, the 5, 5, 5, 105 are made on time. And the third most important assumption in bond market is this. I don't know how many stars should I put here, but this is, I think, the most important line in bond market. The investor is able to reinvest coupon payments at the same yield, which means the $5 that you get, you can reinvest it at 3.6%. The $5 you get, you can reinvest it at 3.6%. Same amount, 3.6%. And $105, the $5 should be reinvested at 3.6. If you can do this, the default doesn't happen and the bond is held till maturity. The return from this bond for you till maturity will be 3.6%. A lot of people misreading this, and this is debatable because at times a lot of people say, why is it that why should I invest at 3.6% if there is a better investment available? Yes, there is no mandatory requirement to invest, but if you do not invest, this is an assumption on which fixed income work. If you do not invest, obviously your returns will not be equal to 3.6%. So the problem is you will have to do this to get to the same return, but no one stops you from reinvesting your money elsewhere. You can invest it, but our bond market works on this assumption. So therefore, this highlighting this assumption is absolutely necessary. Okay, perfect. Give this a try. So I think try these two. Give a try to question number 2 or part 2 and part 3. Do not try part 1. Give it a try. I'll wait for you. 2-3 minutes should be more than enough to solve this. If you have calculated or if you want to use the website ba2plus.com, try that. Let's see what your answers are. What is the price that you are getting? So look, you have been given N. N is equal to 10 years. You have been given coupon rate, right? So the coupon or the payment on your calculator will be 1.6% multiplied by $1,000, which means payment key will have $16. I by Y, YTM has been given to you at 2%. So that will be 2. Face value. Face value is already given to you at $1,000. So for this, how much is your price?
So for the second one, what I've got is like minus 964.
Correct. Minus 964.07. And the minus sign indicates you are going to pay this. If you have to buy the bond, you will have to pay this. Therefore, this is an outflow. The minus sign indicates an outflow. The bond cannot trade at negative number, but this minus sign indicates an outflow. The price of the bond is 964 in this case. Perfect.
And for the second one is minus 1037.5.
1037.5. Perfect. I'll take that on the face value. In your calculators, you just have to change, I think, the yield.
Yep.
Everything else remains the same for the next question. Right? So at times you should also learn how to leverage your inputs. 137.48. Perfect. Now, this is exactly what the relationship is. If you note, the price of this bond will be greater than 1000. The price of this bond will be less than 1000. And why I not asked you to solve this? The price is equal to 1000. What is the relationship? The relationship is if coupon rate is equal to YTM, which means what I offer and what you want. If that is the same, the price of the bond is equal to the face value. There is no difference. You don't pay a premium, you don't pay a discount. You buy it at the face value. But if I offer you less than what you want, correct? Less than what you want, which means coupon rate 1.6% and the YTM you want is 2%. This case. In that case, this is a security which you will not like. This is a security you won't like. And if you won't like it, the price that you're going to pay will be less than the face value, which is 964. Because you don't like this security. You say, I don't like it because you're not offering me 2%. I want 2%. And the third case where coupon rate is greater than YTM. 1.6% coupon rate. YTM, you only want 1.2. I am giving you more. And if it is more, it is always desirable. Then you are going to pay a premium to buy this. So this bond will be issued at a discount. This bond will be issued at a premium. And this bond will be issued at par. This relationship is critical for us to remember.
So we always talk in reference as a borrower.
You always talk either, no, I'm talking always as a reference of the person who is buying the bond, the lender.
Like
If
an
you buy
investor,
the,
right?
yeah, as an investor, yes.
So I think in that situation, if I'm paying 964 and if I'm getting 100, like 1000 in the end, it's a benefit for me, right?
Yes. And why is there a benefit? So think, you were offered a security which is not desirable. Why is it not desirable? Because you want to, I'm giving you 1.6. You are the investor, I am the company. So you are going to tell me, Tarun, I am going to buy this from at 964 rupees from you. Why are you buying at a discount? Because you don't like it. How do you compensate yourself? You are saying I'm going to buy it at 964. but when the bond will mature, you are going to pay me back 1,000. And this additional 36 rupees that I am going to get, or dollars that I am going to get, is going to compensate me for the 0.4% difference that I want. So which is why you buy at a discount, you redeem at par, and that additional $36 helps you bridge the gap between 1.6 and 2%. So net you still get 2% return. If this is a premium, if this is very desirable, you pay higher price. So it's always prices from an investor perspective. Obviously, the company is going to get $964 as money when they sell the bond, and they pay back $1,000. So the additional 36 that they pay is their cost of borrowing this money. In case in the exam you forget these relationships, I generally advise everyone, do not try and memorize these. There are so many things in level 1 you cannot memorize. Simple, if you forget, put random numbers in your calculator, solve them. Random numbers like this, solve for them, and once you solve, you automatically can derive the relationships rather than just memorizing them. So practice deriving relationships when you are doing mock exams or preparing yourself. It would go a long way in your understanding of the subject and making you comfortable with finance, because there are more than 1,000 relationships, etc., formulas for you to remember. I don't know whether 3 levels you'll be able to do it. So I think just derive. So that's why even if I don't remember this initially, I used to derive them with dummy numbers. Today also I can derive them using an Excel sheet or a calculator. No need to memorize anything. I think it's pure mathematics. So this is one very important relationship between coupon rate, YTM, and price. Solution wise, I think they've obviously put up the relationships here, the ones which we were talking about, that a bond will trade at a par, at a discount, or at a premium, depending on where is the coupon and the market discount rate, or what is also called as your YTM, yield to maturity. So you can put these numbers in your calculator and you can do a CPT of present value. It should be ideally written like this: CPT compute present value. Okay. So it should work out for you. Now, if this is a semi-annual coupon bond, we change one element. Semi-annual coupon bond. In our initial example, we assumed annual coupons. If it is semi-annual, your adjustments are this. You will have to put N, which is number of years, into number of coupons. So we had 10 years. Because this is semi-annual, you are going to put 20 in your calculator. Similarly for I by Y, that I by Y itself is a hint for you. I divided by Y, which means if your yield to maturity was 2%, divide 2% by 2 here and put in your I by Y 1%. And in PMT, again, you will have to divide. So your coupon payment was $16. You will divide it by 2 and put $8 in PMT. So if I take this 10, 1.6% and YTM of 1.2, so 1.2% by 2, which is 0.6%. Calculate the price of the bond. Let's quickly do this. I'll also put it on my calculator. What is your answer?
Minus 902.
Minus 902. With a 2% YTM or a 1.2% YTM?
With so if it's YTM is 1.2, so it would become 0.6, right?
0.6%, correct.
Okay, I'll just take a look.
I think the simple hint is this is 1.2, this is 1.6. We just talked that if coupon rate is greater than YTM, it should logically turn out at a premium, right? So the price should be more than $1,000.
Sir, 1037.59.
Absolutely right, sir. 1037.59, and I think that is what others should also eventually get. I think would 2%, but I think it should be at a discount. Yep, the answer should be 1037.59. Works. Does anyone need help in solving this?
We are good, sir.
Okay, all good, perfect. Next then, what else if this relationship is clear? Now the relationship between other variables. The first one, and again, very important slide from, forget about exam. I'm sure you'll do it in the exam, that I think a lot of people will handle. But this is also sometimes when you read finance, there are certain things you should understand upfront. And if you don't understand them upfront, they will eventually go and bother you a lot in CFA or in your day-to-day work to that extent. So this slide is, I think, that slide which is, I think, top of the list. If you don't understand anything from today's class, I think I would be okay with it. But if you don't understand this and the one which we just did in terms of calculation, that is a problem. That is something that we would expect you to get it in quick and fast format. Let's look at the first relationship. We talked about this last class, price yield relationship. Price of the bond keeps reducing if the yield keeps increasing. If interest rates, or like they are known as YTM, keep increasing, the price of the bond will keep decreasing. If the price goes below par value, we call it a discount to par. If it is above, premium to par. So your first relationship is inverse, right? And that is something we already covered. Price is inversely proportional to YTM. Again, if you forget, I don't think you should even bother about remembering it. Just solve for any example mathematically like this. Put different YTM numbers here, 1%, 2%, 3%, 4%, and you will see the price keeps falling every time you have a higher YTM. This is a simple example that if you increase the YTM, the price of the bond will fall. Second, coupon rate. What is the relationship? Bonds with lower coupons are more sensitive to interest rates, which means there is a higher risk. Now, always remember, if I give you lesser money every year, then your risk is higher, because if interest rates increase, you will lose more. The price of the bond will fall very fast. So bonds with high coupons have low risk. Simple way to understand: you have given me some money, I have to return that money back to you, right? I have borrowed some money from you, 960 rupees. I have to give it back to you. How will I give it back to you? I will give you coupons, and I will also give you uh, the principal value at maturity. Now, if I tell you I'm going to pay you 111 rupee for 5 years, and then at the end I will pay you $1,000, versus I'm saying I'm going to pay you 50, 50, 50 rupees bonds, higher coupons, and then I'll also pay you $1,000. Obviously, your risk is lower here because you are getting higher payments earlier. So higher coupon is lower risk. You get at least some money in your hand, versus this where you are getting lower coupons as such. So coupon sensitivity, lower coupon, more sensitive to interest rates, higher coupon, less sensitive to interest rates. Again, the relationship is inverse. If you want to put it that way, they're inversely related to each other. Maturity. You should not even read the English. Just understand someone borrows for, and the one which we were talking right a few minutes back, someone borrows for 10 days versus someone borrows for 10 year. Where is your risk more? 10 days is lesser risk because you know in 10 days you can catch hold of the person and collect your money. But someone who borrows for 10 years, how long will you catch hold of that person is a problem. In 10 years, a lot of things can change. So bonds with longer maturity are more sensitive to yield, high risk. Bonds with shorter maturity have low volatility, low risk. Convexity effect. Price yield relationship is convex. You see this graph? This graph is convex. It is bent like this. This is not a linear graph. This is a convex graph. And if this is a convex graph, the problem is a price increase from a given yield decrease is larger than the price decrease from an equal yield increase. Okay. Let me prove this mathematically to you. I'll just use my Excel sheet to do this. That would help me get this done quick and fast for you. So let's just try an Excel sheet here for you. You can do it on your calculators. I'm just I don't know. I'm in love with Excel sheets for 14 years, so I just prefer using that most of the times. Just Pankaj just forced me to use a notepad to write. Otherwise, I would have taught you this on Excel itself. But I think that's fine. I think we can work it out. Okay, so let's try this relationship, and I think then the English will make a lot more sense. Right? At times, I generally believe English confuses us, but numbers help us. I'll put the English for your reference here, right? So you can at least have the English visible when we talk this concept. Okay. So this is the English that we are trying to prove. Let's set up a bond here with N, with coupon, let's say years to maturity, coupon, par value, uh, and what else do you need? Oh, coupons, years, YTM, yep, sorry, YTM, and the price of the bond. Perfect. Let's say base case. This is my base case. Base case means I am saying I have a 3-year bond. Okay. Coupon rate, let's say, is 6%. So I'm not going to change the coupon rate. I'll just keep it flat at 6% for all my calculations and all my assessment for now. So if there is a 6% coupon on a par value of $1,000, this amount will be obviously $60, right? 6% into 1,000. Perfect. And let's say the YTM that I am trying to work with is 7%. Okay, this is what I think we were trying to solve a few minutes back, that what should be the price of the bond. So the price of the bond, if I do it in Excel quickly, rate, which is 7%, number of periods 3, PMT $60, and face value $1,000 is $973. And typically negative number, but I'll just showcase it positive. So this is my price of the bond. Okay, what you were doing on your calculators. Now, let's do 2 more cases. One case this side and the other case on the right hand side. And what are we trying to work around in the case? So we are trying to work around YTM minus 1% and YTM plus 1%. This is the only change I am going to do. These are the only variables I am going to change, which means my YTM goes to 6% or my YTM goes to 8%. Okay, nothing else changes. Everything else is the same. But this proves that if YTM keeps increasing, price of the bond keeps decreasing. One relationship we were talking about. And now let's talk about this point. A price increase from a given yield decrease. Okay, so the yield has decreased, the price has increased. How much? Let's calculate the change. Percentage change in price. The price increased to $1,000 from $973. The increase in percentage terms is 2.695% increase. Okay, this is the increase. So the first half of the English is a price increase from a given yield decrease is larger than the price decrease from a equal yield increase. Equal yield increase, first we decrease by 1%, now we're increasing by 1%. So equal yield increase, price is increasing, and in this case the price is decreasing. So the price decreased from 973 to 948. The decrease is 2.598. If you compare them on an absolute basis, which means forget about the sign of the numbers. If you compare them only on an absolute basis, the relationship is proven. This is the English. A price increase from a given yield decrease is larger than the price decrease from an equal yield increase. Why is this happening? This is because your curve is convex in nature. It is not linear. If this curve would have been linear, then the change would have been the same on both sides. So that is the relationship I think that we are trying to debate and talk about here. So this is called as convexity effect. And the convexity effective is something that you have to live with in fixed income. There is not much we can do around this. But to mathematically prove it, you can just prove it with these numbers, like random numbers. Take a number, subtract it by a X percentage, and it's not necessary 1%. You can actually do it for any percent, 6.5%, 7.5%, half percent, right? And you will still see the relationship holds valid. The only condition is it should be equal on both sides. And this is called as the convexity effect in fixed income. The same example proves this, that if you increase or decrease by 0.4%, then the price change is different. The rise in value versus the fall in value. The rise in value is always more than the fall in value. So from 1.6 to 1.2, the value goes from 1000 to 1037. From 1.6 to 2%, the value goes from 1000 to 964. So the one which we did on Excel, you can prove it using any other numbers of your choice. This is helpful. Did we understand the concept? Anything that bothers you? Okay, perfect. So this is convexity effect, and always remember this is also a small problem. As we move forward, we will try and rectify this problem also. We will try and find a solution of this problem also. Okay, but at present we will say this is okay. Let's live with this for now as a convexity relationship. Now, the other thing is constant yield price trajectory. What does that mean? With the passage of time, the bondholder comes closer to receiving the par value at maturity. So the simple example is, if this is the par value of the bond, $100 is the par value or the face value of the bond, you can buy the bond at a discount, you can buy the bond at a maturity. But as you come closer to the maturity of the bond, you see the discount bond, the value of the bond increases and goes to $100. The value of the premium bond reduces and goes to $100, which means a discount bond will eventually go to 100 and a premium bond will also go to 100. So by the time the bondholder comes closer to receiving the par value at maturity as the time passes, And this is called as a graph which is called as pull to par graph, which means the value will be pulled to par at maturity. Whether you start below your face value or above the par value, the value will gradually go to $100 as you hit maturity. This is called as amortization of the bond. So amortization of premium or discount, whatever it is, gradually you will amortize that premium or discount and get it to maturity value. That is called as constant yield price trajectory or pull to par. At maturity, the bond has to retire at face value. In addition to this, what we have done, we have calculated all the interest or coupons as of the date of issuance. However, remember, if you are valuing a bond between coupon dates, right? So what happened? All the calculations which we did till now, we have done this. 1 year, 2 year, 3 year, 4 year. So we said there is a 4-year bond. You will get coupon here, you will get coupon here, you will get coupon here, you will get coupon here. Let's say $10. And you're going to get a premium face value here, $1,000. But this is assuming all the payments or the bonds are calculated as of the issue date. Right? All the calculations we were assuming, we are standing here and we are doing the calculations. But it is not necessary this is going to happen always. Right? You can come and tell me, Tarun, I missed buying the bond when it was issued. Right? So I missed buying it today. Now I want to buy the bond and I am standing here in time. This is the time I'm looking at. And I want to buy the bond. So if you are going to value between coupon dates, this is a coupon date, this is a coupon date. You are after 1 year, before 2-year coupon. So you are in between somewhere. The price needs to reflect portion of coupon which is owed to seller, right? So I purchased here, I buy the bond, and at this time I'm going to sell the bond. It's not necessary for me to hold the bond till maturity. I'm going to sell the bond. And if I am going to sell the bond, you are buying the bond. But if you are buying, you will have to make this interest payment to me. This interest payment belongs to me because I have held the bond from 1 year to, let's say, 1.2 years. This time frame, I am holding the bond. So you have to make the interest payment for this small time to me. And the remaining after this, you can take the money. So how do I calculate interest for this small section for which I have held the bond? Accrued interest is equal to coupon payment, which is $10, into days of last coupon to settlement divided by days in coupon period. So there is a possibility 360 days for the next coupon, 365 days for next coupon. I have held the bond for, let's say, 80 days. So 10 into 80 by 365. This is 80-day period, which I am holding the bond for. So you will have to pay me $10 into 80 by 365 when you buy the bond from me. Because out of 365 days, I am holding the bond for 80 days and you are going to hold the bond for the remaining time period. This is called as accrued interest. And this is what I think we would like to typically add in our calculations. Okay, so always remember, if you're going to sell it in between the year, 1 year, 2 year, 3 year, in between, if I am holding the bond for this 80-day period, out of this 365 days period or 360 days period, depending on how you want to use it, some bonds are on 360 days, some bonds are on 365 days. You simply can look at this and give me 80 upon 365 as the payment. That is my accrued interest. That should belong to me. Example, a government bond pays 4.625% semi-annual interest on May 15 and November 15. Semi-annual, 2 times. using actual by actual. Calculate accrued interest for 27th June settlement date. And similarly, a corporate bond. Calculate interest for a different settlement date. So step 1, when you're going to do accrued interest, face value is not given to you. Okay, in this case we have not given you the face value, and that may happen in a lot of questions that you don't get face value. That is absolutely fine. Assume a face value, you should be okay. The two most common assumptions are $100 or $1,000. Okay, you can assume a face value on your own. If your question and the options are in triple digit like 998, 982, 979, you will have to work with this. If your options are in two digit like 98, 96, then you have to assume $100. Okay, those are your two standard assumptions. So let's say my accrued interest is on $1,000. So I'm going to get $46.25 as coupon. But because this is semi-annual, I'm going to get 2 times coupon divided by 2. And then obviously the time between these two dates in the examination, generally the days will be given to you. You don't have to calculate from May to November how many days are there, right? They will give you the number of days. So 15 May to 15 November, let me just quickly do this on my Excel and see how many days are we looking at. So 15th November, and what was the other date? I'm sorry, 15th May. Okay, so the difference between these two dates, 184 days. This will be given to you in the exam straight away, right? And we have to do on 27th June. So June 27th settlement, which means how many days did you own the bond? June minus 15th May, 43 days. Okay, so the math is very simple. $46.25, this is the coupon, divided by 2 because it is semi-annual. Coupon multiplied by 43 divided by 184. And what you get is your accrued interest, $5.4042. But the exam will make life easy by giving you this and this. So don't worry about the day calculation. I think that's pretty much something that you will be able to handle. Remember, this is actual by actual, right? Which is why we are doing actual by actual and we are not doing anything which is random here. But if this is not actual by actual, like in the second question, in the second question, you see the convention to use is 30 by 360. Okay, so then you will simply say between these two, how many days? We will assume 30 days per month. And because we are going to assume 30 days per month, from May to June, July, August, September, October, November, the difference between these days will be 180. So then your calculations will be 46.25 divided by 2 into 42 days, 43 days, or whatever that time,
43.
right? But because this is 30 by 360, you will have loss of a day in between. Okay, so that day I think should fall then down to 42 and divided by 180. Okay, because then you won't have May 31, right? You are buying it in June 27, you won't have May 31, right? So one day will be reduced, and this whatever comes out is your accrued interest. Right, so in exam you will be given the number of days, don't worry about that. If not given, I'm sure you can still calculate them, but generally I've seen they generally provide those days, right? So it should be okay. Yes, so 43 upon 184, 42 upon 180. And why do we lose one day? Because May 31 will not be there. We'll assume all months equal to 30 days because we are doing 30 upon 360. Actual upon actual means 29, 30, 31 days will be considered, and denominator will obviously also have 365 days. So you would be expected to calculate these accrued interest numbers. Clear? Okay. Now, how does this accrued interest play for our calculations? So this accrued interest goes in your flat price and full price calculations. Flat price is known as clean price. Full price is also known as dirty price. What is this math? Same timeline. 0, 1, 2, 3, 4. And I am going to sell the bond here at 1.4 year. Okay. Price at time equal to 1, price at time equal to 1.4 will be different. Okay. So full price between coupon dates and deduct interest to find the flat price. What you will get at P1 is called as a flat price, which is without accrued interest, because at this point there is no accrued interest. Your interest is already paid year 1, so there is nothing accrued. So flat price is always equal to clean price, quoted price without accrued interest. This is the price as at coupon payment date. On the date of coupon payment, whatever the price is called as flat price. So there will be a flat price here, 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 everywhere there will be a flat price. The full price, dirty price, invoice price is flat price plus accrued interest. So the price here at time equal to 1 plus accrued interest, which is this time. So this will be flat price plus accrued interest. So if someone says calculate full price between coupon dates and deduct accrued interest to find the flat price, it should be easy. Calculate the price here. From this, subtract accrued interest, you will get the flat price. So either ways, you can work. The most important equation is this: full is equal to flat plus accrued interest. And then you can work out any mathematics that you want. That is one equation. And if you want to do it based on this calculation formula, you can do this. Present value on the last coupon date, which is your flat price, multiplied by 1 plus r raised to the power n, so that the accrued interest can be done on its own. So 1 plus this formula, and you can calculate your accrued interest in this one shot. Let's give it a try. So let's take the example at the bottom. 4.6525% or 4.625% euro annual pay actual by actual coupon bond issued by Romania matures on 3rd April 2049. YTM 3.5%. Calculate full and flat price on 15th December 2031. Step 1. We need full and flat price, which means first we should calculate what is the present value on the last coupon date. When we say last, which means the one which has just gone, right? So this is an annual pay bond. Okay. So on the last coupon payment date, which matures on 3rd April 2049. Therefore, the coupon payment date will be 3rd April 2031, right? This is annual pay. If it is annual pay, it should always pay me on 3rd of April, 3rd of April, 3rd of April. So my last coupon was paid on 2031, 3rd April. So I need the price as of this date. Okay. How will I do this? So we are going to say face value. I don't have here, so I'm going to assume a face value. Let's just clear everything out on this screen. Okay. So face value, I'm going to say $1,000. Let's say that is my face value. Coupon payments, 4.625%, which means $46.25. That is also standard. Annual payment, so no problems. YTM has been given to me 3.5%. Okay. And if my last coupon was paid on 3rd April 2031, the time between these two dates is 18 years left. So N will be equal to 18 years. And then we'll compute obviously the present value of the bond. This present value will become my flat price, or what is called as this present value on the last, I think the better word is on the previous coupon or on the most recent coupon date. Let me just put these numbers in quickly in my Excel sheet, see what the numbers turn out to be. Let me just use this itself. So 18 years, 46.25 on par value $1,000. YTM was 3.5%, 1148.38. This is the present value on the last coupon date. See if you get the same number on your calculators.
Yep.
Perfect. So the idea is, I think when you solve such questions, just be aware about some implicit data. It may not give you everything on straight in the question. Like in this case, we had to assume, or we had to figure out what is the last coupon date. And the assumption is very simple. This is an annual bond. So if this matures in 49, 3rd April, whatever date is just before this, 31, 3rd of April is the date. So we got the full price here. Okay, or rather we got this price, sorry. Now, once we have this price, we can calculate the full price because we also have the YTM. We know this number is 3.5%. We know periods per year. This is an annual pay bond. So this is one, doesn't matter. Days since last coupon. How many days have passed since the last coupon? So from April to December, how many days have passed between these two dates? 3rd April to 15th December. So you can do that math quickly. 3rd April to 15th December. And I can do a quick math here for you. 256 days have passed between the two dates. So I'm going to use 256 here divided by days in the coupon period. If this is a leap year or not a leap year, depending on whichever, that is 350, 365, 366, whatever the number is, put that here. And you should get a full price. And from full price, subtract accrued interest, you will get your flat price. So what is accrued interest in this case? 46.25. You are holding the bond for 256 days divided by 365. That is your accrued interest. So step 1, calculate present value of last coupon date using this. In this case, obviously, this is not the flat price. This is the coupon date. Then calculate the full price. And from the full price, subtract your accrued interest to get to the flat price. This is so present value on last coupon date 1148.38. What was our number? 1148.38. Perfect. And then if I multiply this 1148.38 into 1 plus 3.5% raised to the power 256 days divided by 360, sorry, divided by 365 days. This is a leap year or not, I'm not too sure, but yeah, 1176.43. 176.35. The reason being they're using 366 days here as solution, so possibly leap year concept. So that is why 366, but that's fine. I think I'm getting 1176.43 vis-a-vis their number of 1176.35. That's fine. And from this number, so let's also just put it on 366 for comparison. From this, which is my full price, I have to subtract accrued interest, and accrued interest obviously is 46.25 into 256 divided by 366, $32. So from this, if I subtract 32.35, I get my flat price. $46.25 into this, and from 1176 minus 32 gives me my flat price. And remember, this is called the dirty price, this is called the clean price. Sometimes I think the words can change, but yeah, the concept is the same. All good? Works? Perfect. This is helpful. And let's roll forward. Okay. Then we move towards the last concept for the day, which is matrix pricing. Now, what is matrix pricing and why is it used? So the point is, some bonds do not trade actively in the market, and therefore market price or YTM is not available at times. Some trade actively, therefore it is available. Otherwise, in some cases, it is no market price or YTM is available. This is English is a bit confusing, but the key thing is no. There is no market price, no YTM. None of them is available because they don't trade actively. Therefore, to estimate their value, analysts will use price or YTM of similar bonds which are actively traded. Classical example, there is a 1 year, 2 year, 3 year, 5 year bond. But I want a 4 year bond. My requirement is a 4 year bond. There is no 4 year bond actively traded. So what can I do? I will look at 3, I will look at 5, and based on this, I will estimate 4 because 4 is not traded. So comparable bonds are 3 and 5 year bond for me. They should have similar time to maturity. 3 and 5 average is 4. So similar time to maturity, similar coupon rates, and same credit quality. So they should also be, let's say, a AAA, if my bond is a AAA. Or depending on the quality of my bond, I should pick up same. And this technique is called matrix pricing. Okay, so this is typically used to approximate the YTM or price for an untraded or newly issued bond, because newly issued bond will not be traded. Take an example. Value a 3-year 4% semi-annual coupon bond which is not actively traded. They have given us bonds with similar credit quality. One condition to be very true, similar credit quality. So they've given us 4 bonds, 2-year, 2-year, 5-year, 5-year, 3%, 5%, 2%, 4%, prices of the bonds and YTM of the bonds. Calculate average YTM for each maturity of similar credit rating, 2 years and 5 years. Estimate 3-year YTM based on linear interpolation matrix pricing, and use this YTM to calculate price of the untraded bond. So we have to do 3 things. Let's give the first shot. Average YTM for each maturity of similar rating. For 2-year, the average is mix of these two. So now out of 2 bonds, we have created 1 YTM. Next to average this. So what you have done, you have calculated average YTM for each maturity of similar rating. Each maturity, 2-year, 5-year. Rather than 4 data points, now I have only 2 data points, 1 2-year, 1 5-year. That is your first output. Second, estimate 3-year YTM on linear interpolation. So now you have 2-year number, you have a 5-year number, and you have to estimate a 3-year number. 1 year increase in YTM, the difference between the two, 0.385% divided by 3, because there is difference of 3 years. So the way it will work is, you will say 4.1885% minus 3.8035% divided by simply 5 minus 2. You will come at this, that in 1 year it is increasing by 0.1283, which means if I want 3-year YTM, I should start here, and in this I should add 0.1283. 1 year, I'll get my YTM for a 3-year bond. Simple linear interpolation. Total increase divided by how much is the increase, and you add that to your, if I say 4-year, then you will add 3.8035% plus 1.1283 plus 0.1283%. One more time, you will get a 4-year. Next, using this YTM now we have already estimated a YTM, right? Our YTM estimate is what? 3.9318. So we have already said 3.9318, but because this is semi-annual, divide by 2. Payments $40 by 2 because this is semi-annual. Face value 1000. N6. 3 into 2. 3-year bond, 3 into 2. 4% bond, 40 by 2. Semi-annual because. So YTM is also by 2. What you get is your present value of the bond at 1001. So matrix pricing is nothing but linear interpolation. You should know how to do linear interpolation, and therefore it's pretty easy if you get the fundamental concept. Get one end of the pole right here, the other end of the pole here. What is the distance between this and this? And divide the distance by the range. The difference between this and this divided by the range, and add the range every time you want to go forward. The addition should always start from the beginning. Take the base number. This is your base number. And from this you keep adding. You'll reach the numbers. Rather than memorizing the formula, I think logically that is the way to solve for linear interpolation. So let's try this question then. A corporation has a 4-year 3% annual coupon trading at 102.4. The YTM is this. The corporation is considering issuing a 5-year bond. 3-year, 5-year government bonds have YTM of 0.7 and 1.45. Okay, important. This is a corporation. You have been given government bonds, so there is a difference. Government bonds are less risk. Corporation has high risk. What you will have to do here as a different concept. Step 1, you will have to look at what is the spread. So let's first look at 4-year, because the company has to issue a 4-year, or company already has a 4-year bond. So let's take an average of government. Government 3-year plus government 5-year by 2, right? So 0.75% plus 1.45% by 2. This will turn out to be 1.45 plus 0.75, that is 2.2 by 2, 1.1%. Okay. This is government 4-year, right? Linear interpolation, average. Your 4-year is at 3% coupon. YTM is 2.36. Okay. So when I say your YTM is 2.36, I have to see how much is the spread. So I'm going to say the spread, because you are more risky, is equal to corporate 4-year minus government 4-year. 2.36 minus 1.1. Perfect. And that tells me that your bond has a spread of 1.26%. In this, spread calculation is important because corporate bond is more risky than government bond. Government 4-year is at 1.1%, corporate 4-year is at 2.36%. So the difference between the two is the spread. And now this company is planning to issue a 5-year bond. So what we are going to do, we are going to simply pick up government 5-year, which is at 1.45%, and add to this the spread of 1.26, and we are going to say corporate 5-year will trade therefore at, this is 1 and 1, 2.71, and this is the way to solve this. In this example of matrix pricing, they are working with spreads. They are not working with simple corporate bonds. So step 1, calculate government bond 4-year. Step 2, check what is the spread between government and corporate 4-year. And then that spread should be added on government 5-year, because they are planning to issue a 5-year, and government 5-year bond trades at 1.45%. Works?
Yes, sir.
Okay, perfect. Oops, 1.1%, 2.71%. Yep, similar solution. Perfect. So I think that is it for the day then. If